third quarter results are already there with you. As usual, I invite all of you for a discussion on the matter. And our Shuldas Kamas, JMD, as well as our Rajinikanth Sabnavis, our COO, will answer all your questions. Thank you.
Hi, good afternoon, everyone. This is me, Rajinikanth Sabnavis. What I'm going to do is to run you through the presentation that we have on our results for the quarter. Yeah, so I will take you through the presentation, at the end of which I will invite you to talk to us. So first, market scenario. As you're aware, on 15th November, there was a correction in GST rates, which is basically in dishwash and laundry as far as we are concerned. With that, we saw urban consumer demand getting a spike, and we passed on these benefits to the consumer, and that is what benefited us as a company. As far as rural demand is concerned, it looks better than before. The trade channels have more or less adjusted to the new GST regime, although there are some parts which are still affected, and we'll talk about it when I take you through our brands. As far as CSD demand, which I had mentioned last time, was still coming back to normal, now it's fully back to normal. Now, before I get into the results, I'll give you a quick background, and this is very important for us to keep in mind as we go along, which is that if you take Q3FY18, GLL had actually outperformed the market in the so-called demonetization quarter. So please keep that in mind, otherwise there is this constant question of base effect. In fact, we grew nearly 4% in terms of volume and over 3% in terms of value in that quarter, and the month of December was actually 13% growth. So that's just a quick background to keep in mind. Now I'll come to the results and I'll take you through it in terms of the snapshots. You get a one-shot look at what the results are. In terms of revenue growth, we have grown at 15.9%. I'm talking about our FMCG growth because once we get into brand wise, you'll see the breakups. And in terms of volume, it's a double-digit growth. It's 11.5% growth. As far as A&P expenses are concerned, we invested behind our brands. A lot of campaigns we had spoken about last time as breaking in December quarter went on air as scheduled. Nearly a 25% increase in our A&P, and our A&P to sales ratio as a consequence is 7.5% versus 7.2%. On gross margins, we have seen a slight increase of 130 bips versus the same period last year. This is really on account of the mix, and we'll talk about it when you see the brand-wise growth. So we've had good growths on Ujala, Margo, and liquid vaporizer, which give us higher gross margins. Coming to our operating EBITDA growth, over the same period last year, it's a 36.2% growth. We made 69.3 crores of EBITDA. As far as PAT is concerned, we've seen a growth of nearly 60%, 32.9 crores versus 20.7 crores. And EPS is also consequently up over 59%. So that's our results at a snapshot. Let me just give you a quick look at the next chart, which really gives you a picture at the quarter end and at 9 months end. We did 431.2 crores, which is a growth of 15.9% total as a business, and that's a 15.9% growth. As far as our YTD sales go, we are now in the positive territory. Our overall GST combined growth is 2.6%. So that's as far as the YTD sales go. Now coming to category-wise consolidated revenue at a snapshot on the next chart. This is where you can see the breakup by category. You can see in fabric care, we are up by nearly 18%. Dishwash is 19%. Household insecticides, and I'll talk about it in a bit of detail, is -10%. That was the only dampener. Personal care is up 38%. Overall, our FMCG business is up 16.2%. And that's how the total really pans out. And if you take the total at a company level, FMCG plus non-FMCG is 15.9%. Next chart, we'll talk about our brand-wise growth. In terms of brand-wise growth, we've done very well across all our brands, with the exception of Maxo, and as I said, I'll come to that. Ujala has grown 17.3%. This is a total franchise. including fabric whitener. And we'll talk about individual components later. Exo franchise 19.1%. Maxo is -10. Henko, the entire franchise, is up 23. Margo is up 43% actually as a brand, and April is up 21.5%. So overall, our power brands are up 17.5%, and altogether we are up 16.3%. So that's the breakup of the brand level. Now coming to a snapshot of the consolidated performance. You've got here quarter ended and YTD and the ratios below that. So if you see, our sales are up 15.9%, and this is all businesses together, and 2.6% YTD. Operating EBITDA is up 36.2% in the quarter. As far as EBITDA is concerned, we are still trailing a little bit behind because of our first quarter performance, and we are at -7. And as far as PAT is concerned, the quarter, as I mentioned, was 59, and YTD is 6.4. The same thing translates down to EPS. In terms of ratios, our gross margin, as I said, was 130 bips over same quarter last year at 48.3. On a YTD basis, we are 10 bips up, 48.9. EBITDA margins, 16.1 versus a comparable 13.7 in the same quarter last year. More importantly, on a YTD basis, we are at 14.6 and very close to the 15% we spoke of at the beginning of the year. PAT margins, you can see for yourself what they are, and the A&P to sales ratio also tracking well. Now coming to the company's consolidated performance, 13.7% is EBITDA of Q3 of the previous period versus 16.1 in the current period, which is the last line. And EBITDA percentage YTD 16.1 previous year versus 14.6 this year. On gross margin, you can see again we are 1.2% up in the quarter, 0.1 above on a year-to-date basis. The rest of the metrics you can see for yourself over there. Now I'll come to brand performance and initiatives. Our businesses are split here for your benefit to take a look at. Fabric care, which includes main wash as well as post wash, is 42%. Then you have dishwash at 31%, and then you have personal care, household insecticides at 11% respectively. So we'll move in the sequence. First, I'm coming to fabric care. Fabric care is 42% of our total business. As I mentioned, we've grown 18% in the business. Importantly, we break it up into our franchises. You've seen Henko grow at 23%, Ujala powder grew at 28%, Crisp and Shine at 22%, and Ujala Supreme at nearly 10%, 9.7%. All of this has been on the back of some very powerful mixes which we spoke about in the Broken schedule. Ujala IDD had a new campaign going in which got us 28% growth. Crisp and Shine has a new campaign coming in January. We continued with the earlier campaign. We grew 22%. Ujala fabric whitener is up 9.7%, and indeed we have a new campaign coming up in January. So we expect to continue growing. Now coming to dishwash. Dishwash overall growths are 18.9%. You have Exo growing at 19.1 and Pril growing at 21. Please come to the next chart where I'll explain to you the breakups. We refurbished all our mixes in dishwash. Exo dishwash bar, we broke a new campaign in October, and our bar business grew at 20% on the back of a 17.7% growth in the previous quarter. We had two great quarters, one after the other on dishwash. As far as our scrubbers go, we launched our range of India's first antibacterial scrubber, position on the proposition of 94.2% less malodor. It worked well for us. We've grown 23.2% in OND versus 20% in the previous quarter. So that part of our business is also doing well. Pril liquids, I spoke about breaking a new campaign which we broke on schedule, and as a consequence of that, the quarter has been very good on the back of this campaign, and we've seen a good growth of 24.5% in OND. Last quarter was low. I now come to our personal care business, which is again 11% of our total business. Here, Margo continues its growth, very strong growth. We grew 43.4% in the quarter, 37.9% overall. It was backed by strong support in media as well as very powerful activation on ground. The next chart, which is the Margo growth journey. This is an important one. We have put a lot behind this restaging of the brand. Indeed, we believe that there are 2 or 3 things which are very critical and important that we have observed. One is clearly Margo is right there riding the naturals wave. We are seeing 56% versus overall 40% growth in our non-traditional markets, which is another very good sign. And our household penetration has increased by 60%. So strong all-round growth on Margo, which is another good journey. I now come to the household insecticide business, which is 11% of our total business. I had said at the beginning we've declined by 10%, but really when you break it up, it is a tale of 2 parts. One is the liquid vaporizer, where we've grown by 33% actually in the quarter, whereas our coils has let us down, where we declined by almost an equivalent amount on a slightly bigger base, and therefore a 10% decline. We see 2 factors which are affecting this. One is that our brand is over-indexed in the north and the east, which is very wholesale dependent, and both as a geography as well as a category. The wholesale is very critical in these parts, and there we are still disrupted. And then we've seen some early onset of winter, which has muted sales and prevented the trade from downstocking. So that's the reason, from upstocking, I'm sorry. And that's the reason we are seeing this decline. Continuing on household insecticides, I spoke last time as well. We had landed the Genius innovation, which was a completely new innovative product in the machine segment. As briefed, getting that innovation is very important because in liquid vaporizers, it's really the machine and the innovation you talk about rather than the liquid vaporizers. In line with what I had said last time, we have seen our machine business again getting 100% growth. It's up 100% once again, which we grew last time. And Genius, the new innovation, is nearly 10% of the total liquid vaporizer sales in December quarter. So we will continue supporting this innovation and continue driving the liquid vaporizer business. I'll just talk a little bit about GST and what we had done during the period. As you will recall, this came into effect from 8th November. The next chart tells you what exactly we've done. We used these posters and flyers across markets. We immediately passed on the price benefit to consumers as we cut our prices across SKUs. In the next sheet, we'll also tell you some consumer promotions that we specifically ran during the period to ensure the benefit goes to consumers. Needless to say, in some of the packs which are round coinage packs, which is the 5 rupee, the 10 rupee, etc., we increased grammage to pass on the benefit. That's really how we responded, and we responded. Coming to the way forward, our brand building and innovation agenda is fully on track. So we will continue on that journey just as we did during the December quarter and got rewarded for it. We have a very strong go-to-market strategy, which is backed up by a strong, enabled by a strong IT platform. This is fully in place now as we link up with all our wholesale markets and help our field force be more efficient in the market. So that is in place. As far as the demand scenario is concerned, I talked about it even earlier. I would maintain that it still looks positive to us at this stage. The next chart is a quick look at the shareholding pattern. There is no major change compared to last year as such. And that brings me to the end of the presentation. Thank you very much. So we've concluded our presentation from our side. I invite you all to ask us questions and any clarifications that you want from us. Over to you all.
Sure, thank you very much. We will now begin with the question and answer session. Participants who wish to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Manoj Menon from Deutsche Bank. Please go ahead.
Hi team, must congratulate you guys for a brilliant performance in the current market context. Now, just two quick questions. One on Ujala, Stiff and Shine. If you could just help us understand the roadmap. My question is quite straightforward. Going by the success the brand has had in two large states for you, is there, the way I look at it is that why is the reluctance to take it, little more aggressive? That's one. Point number two, is there a bigger play for Margo outside of its, let me call it as the comfort zone of a couple of states?
Yeah. So Manoj, thank you. First, let me clarify. It's not Stiff and Shine anymore. It's Crisp and Shine.
Sorry. Yeah.
I'll start with the second question first, which is Margo. In fact, as I had mentioned, we are growing almost 25-30% faster in our non-traditional markets. And from 4 years ago to now, our traditional markets contribute less than a third. So that's the journey that we've been on this brand. So you're absolutely right to point out saying we need to go beyond traditional markets. When you said traditional markets, I presume you're aware that West Bengal and TN at one time used to be 45-50% almost. Yeah. So now that's down to less than around 30, I would say. Yeah. Okay. Less than that. So we are on that journey, and indeed this whole restaging of the brand and refurbishing, etc., is precisely that. We will continue to drive it outside its traditional markets, and we are seeing success. Yeah. So that's the second question which I've taken. Your first question was on Crisp and Shine, and given the success that we have, why don't we accelerate the rollout? Yeah, that was your precise question. The simple answer is no. There is no. I mean, the way the rollout is planned is very simple, and I'll explain it to you. This is habit building. It's a new category creation. So unlike a Margo, which is a toilet soap, and you leverage a naturals way, this one you need to invest a great deal on ground to educate. And we've picked the learnings. We've had a lot of learnings. What you see are the results, but on the ground we've taken a lot of learnings in terms of what exactly we need to do by way of deploying our mix, both in terms of assets, in terms of how you educate, what you educate, before you can really get the success you want. You are right. Indeed, in TN we have seen good success, and the brand is extremely promising. We will roll it out. We have a clear understanding of the consumer. I don't want to tell you exactly what specifics of the markets, but we know which markets to go to, and you will see rollouts as we go forward in the year, leveraging the learnings that we picked up, especially in TN.
Understood. A quick, same template question for the Ujala detergent powder also. Given what is observed in the market in the detergent category now, that competition is probably intense, but definitely not irrational. Is there again an window of opportunity for you to, utilize basically what the template you had for extending the simple brand stretch of Ujala into the detergent in Kerala? Is that opportunity exists in general for other markets?
So Manoj, I would just request that there are two different kettle of fish, Crisp and Shine and the laundry market. For the simple reason, laundry is a more evolved market with firmly entrenched players. The other one I told you was more about education, creating category. Having said that, we fully are aware that the laundry market is undergoing some change for a variety of macro reasons in terms of where competition is headed. There is an opportunity, and you've seen that in our results as well. So we are going about it. If you know the laundry business, it's a portfolio play. So we will make the right picks and prudently move forward. The answer is yes, we see the opportunity, and that is why you're seeing some growth, but we'll go about it in a smart manner.
Understood. Thank you, and all the best.
Thank you very much.
Thank you. The next question is from the line of Percy Panthaki from IIFL. Please go ahead.
Sir, my question is on the dishwashing segment. You have in the past done very well in this segment and grown faster than the market. Just want to know what sort of recent innovations or actions on the ground you have done that will enable you to keep this market share gain sort of continuing for the next few quarters.
Yeah, hi Percy, thanks for your question. Dishwash is a very important market for us. I spoke very briefly about some of the things we've done which were due in the quarter. They came on schedule. On EXO, In terms of the existing mix, we have strengthened our communication, increased our strength, and if you watch the communication, it is increasing our whole emphasis on the health aspect and on the fact that we are the only antibacterial brand that is effective enough. So we've done that, and we will stay the course on that. As far as product innovation goes, yes, we do have a few things as we go along. On the scrubber bit, and we are the only player who has a sizable scrubber and a bar business. Our competitors don't have it, either the ones in scrubbers or in bars. And it adds back to the brand. We restaged our brand with a significant innovation on bringing antibacterial benefit into the scrubber itself, so it kind of reinforces our whole proposition on EXO. As far as Prill goes, we had broken a new campaign, and indeed it has given us results. We will continue driving it. As far as new product innovations go, we have a funnel ready on Prill based on strong consumer insights, and you will, over time, in the coming quarter and the next, see the rollout of some of these very interesting and exciting innovations. So we've got a packed funnel that will keep the consumer delighted as we go along and help us grow share and grow ahead of the market on dishwash.
Right. And my next question is on the coils category, and I heard your comments on the wholesale affecting performance. So just wanted to know, I mean, it's been now a couple of quarters since GST and actually 4 quarters since demonetization. So just wanted to know, why is it that if wholesale is weak and this was known beforehand that it would pan out to be weak, why could we not sort of let coils piggyback on our direct distribution, which also is not insignificant?
No, so it's a fair question. Indeed, the question on coils is something which occupies a lot of our time, but there are certain market realities, and the fact that we are simply over-indexed on coils in those parts, and they are traditionally operated in a certain channel which is harder to break, as we discovered in those parts than the others. So yes, you are right. It's a fair challenge to say we should get this right. That's one. Then and that's why a few quarters in a row we are struggling, and as I said, we are heavily over-indexed there. The second thing in this particular quarter was the early onset of winter. So these are two things which are really bothering us on coils. And as we speak, we are working out ways and means by which we are able to get around the channel, as you suggested, to make sure that we get our products, especially in the markets of Bihar and interior UP. So we are doing that, and we are extremely hopeful. But yes, it's not been as easy as or rather our attempts have not been that successful as we would have liked them.
Still not fully able to understand the point. You just mentioned that these are sort of products which work on wholesale and it's a hard channel to break. But as I understand, the channel is broken. You don't have to work hard to break it. I mean, they are not able to carry your product. And if you sort of carry it on your own distribution, I'm sure that there is an answer. I'm not understanding it, but just wanted to understand what is the issue and what is the challenge in just shifting it and making it more direct distribution oriented.
Oh, so you're right, Percy. It's not an easy one, because initially my question was I myself could understand certain companies which are totally wholesale dependent whose packs have broken in those parts. I'm not at freedom to name them, but we know what they are. They're pretty large companies. In our case, we managed to successfully deliver on other products. Why not coils? The reality is that there are certain traditional products now, be they tobacco-related products, be they coils. There are certain categories, plastics, confectionery, below certain price points, which these places do dominate. Even in my existing portfolio, what you don't see is certain packs, which are the 5 rupee, 10 rupee packs, which traditionally go through this channel, have suffered. There is no question about it. Now, how do these people operate, without getting into details on a telecon which are not even fair? They may be operating with the unorganized sector or whatever, and how they do business. We can't do business like that. And we are putting in place a lot of measures so that we do business fairly, correctly, in line with the laws of the land, and yet get our products to our consumers by getting around these channels who are not working the way we would like them to work. That's the simple explanation I can tell you at this stage.
Fair enough. So what do you look at as the timeline by which this is normalizing and by which you can expect this category to go back into growth?
See, frankly speaking, if the season works for me, I expect it in this quarter itself. That's a simple answer to you. So we understand the seasonality piece very well. We are now building up to a season that extends, let's say, from mid-Feb all the way till you could say April end, before the summer sets in. And this will be the watershed period when all the efforts that we put in work or don't work. That's my simple answer to you. So answer is yes. Going in now, we are going in with everything that we can to make this season fire for us in those parts.
Okay. Understood. That's all from me. I'll come back in the QFI for the questions.
Percy, thank you.
Thank you. Before we take the next question, we'd like to remind participants that you may press star and 1 to join the question queue. We have the next question from the line of Harit Kapoor from IDFC Securities. Please go ahead.
Yeah, hi, good evening, sir. Just had a few questions. Firstly, on the volume growth, post 15 November, we had passed on the GST benefits in terms of price cuts as well as, offers, etc. So if you could just give a sense about how much of this volume would also be led by, increase in grammages or higher offer-led, stuff.
So that would be a much smaller portion because your grammage increases we have done only on the 5 rupee and 10 rupee pack, and that should be the tail at 20%, the grammage increases and some free stuff. 80% would be the direct price cuts, and you're talking specifically about laundry and dishwash where this phenomenon is there. The rest of it is fine.
Okay. So the assumption is that in these two categories, the tail 20% would have these offers, etc.
And these
the damage additions.
Yeah, and these two categories would be about 35% of my portfolio.
Got it. On the rural side, you made a comment about you are seeing a pickup in rural. How different is the environment compared to probably when you addressed us in the Q2 call versus what it is now? I mean, what are you seeing on ground on that front? If you could just give some.
So I said even in the Q2 call that rural was looking stronger than ever before. It was only earlier that, a year ago that we were a little concerned about the rural part of the business, but we had a decent monsoon, as I had mentioned, and therefore we were feeling good about it even in the beginning of this quarter. I would say that I still maintain that outlook. The monsoons, leave aside a few districts where they've been deficit, everywhere else has been a decent monsoon, and therefore there is I don't particularly see any signs, and this reflects, you see, for us directly in sales of our small packs and certain SKUs which we know are specifically rural. Those parts of our mixes have worked well, and we have succeeded in getting the trade to buy and purchase. Basis this, I would say that rural still looks at this stage strong enough.
The other question was really on this, post GST scenario. Which of so would be fair to assume that in detergents and soaps in both these categories, you would be seeing the benefit of probably some of the smaller players still struggling with or having certain challenges in terms of dealing with the situation, and we're getting the benefit of that. Would it be across these two categories, or would it also be in dishwash?
So it will be obviously more in soaps and dishwash. In soaps for us not much because we don't have a portfolio that addresses that consumer who's seeking soaps at that price. So we don't get the benefit. Again, in laundry, we don't have laundry. When you say you're talking laundry, our fabric care business looks like huge, but actually a lot of it is post-wash. So when you take away post-wash in the laundry business,
right.
Again, we are really, as we've discussed often, playing at the top end, which is the profitable end. So again, while as a category per se, I'm just answering where category per se, it may seem like the bigger benefits are in soaps and laundry. For us, it's really dishwash where we operate, and there is an unorganized sector where we are getting gains with some of these players who are regional in some parts of the north and a few parts in the south where we are seeing advantages by virtue of a level playing field with GST.
Is there any merit in activating some of your lower end detergent brands, since you've obviously not significantly invest in them, but activating them to the extent of gaining some of this low hanging fruit at the bottom if it is happening?
See, laundry is a portfolio play. It needs thought. It looks attractive, but yes, we have a laundry agenda that we are developing. But it's not as simple as, okay, let's go and go all out and from tomorrow you can make it happen. There is consolidation happening there, and there is a very strong player already who's well positioned. So it's not as simple and straightforward as it appears. But yes, overall it is fair of you to say that the laundry category could be a lot more attractive than what it was a year ago.
Last thing was on the tax rate. Just wanted a clarification that it seems a bit high compared to our guidance for the full year. So anything exceptional in that? I see there is a large deferred tax sum sitting there. So
yeah. Hi, Arit. The tax will be 20%. That the MAT will be for the entire year, and this quarter is likely on the higher side because of deferred tax. And for the year, you can still take it at 21% MAT.
21% for this year, right? You said so, and next year as well.
Yeah, for the next 6-7 years.
Yeah. Okay. Thanks.
Thank you.
Thank you. The next question is from the line of Kaustubh Pawaskar from Shear Limited. Please go ahead.
Hi, good evening, and congrats for good set of numbers. Recently, the MD has commented of entering into Ayurvedic space, and we are planning to come into various categories under this platform. So, could you comment more? Have you, what kind of products you would be launching, and in which particular categories you are looking for?
Yeah. Yes. Our managing director had spoken about it. Specifically, the answer he had also given and what we are maintaining is that the natural space looks very, very, very interesting. In fact, I spoke about Margo earlier, and the way it's shaping up. One of you had also asked me about growing it further. So that's one big opportunity which is riding this wave. And the second one is we have a toothpaste called Deem Toothpaste, which is also uniquely positioned in this space. We are developing expertise in this area, and indeed we believe that this phenomenon is here to stay, and we will leverage it in every possible way. So take a slightly larger definition than Ayurveda as the larger holistic health natural proposition, and when you look at it from that perspective, we have an ample scope for growth here.
Just taking this forward, we are not looking any launches in the household insecticide like screams or like your competitive have certain products in their basket out of the home. So you're not looking to enter into that space?
So out of home for now we are not, but we are watching the space closely. We've got a formulation product ideas, but this market has to develop. We are in insect control. We have such huge headroom for growth that right now to go into out of home and develop that market is not priority for us. Having said that, we are watching the space. We have formulation ready. Right now we want to aggressively grow business away from the mixes that we have, the space that we have, and there will be continuous innovations as relevant.
My second question is the rains which happened in Q3 in southern part of the country. Did it have any impact on your numbers for Q3? Any impact on your Q3 revenues?
The rains in the south did not negatively impact our sales anywhere. But yes, there were heavy rains, there was disruption, but it did not negatively impact us at all.
My last question is on the raw material prices. Since we are seeing crude oil prices going up, do we see it having any impact on our gross margins in the coming quarters?
No, at this stage, none. The crude price has gone to 60-65, but we have adequate stock, and you will not see any need for either price increases to ameliorate the effect of those price increases at all in the quarter. We will wait and watch how it pans out as shale gas gets pumped out, and we'll see how the quarter pans out. Yeah, so the simple answer is no, it will not impact gross margin at all for the reason that we have stock. And if you're asking me what's the outlook, let's see what shale gas manufacturers do, and then we'll know what happens to the price.
No, but the stock is still another 2 to 3 quarters, or
No. Wait. What I said, let me just repeat. It is sufficient to see me through this quarter entirely. Okay.
Okay.
There has been no ripple effect of this price increase as recent as it is on any of the plastics or anything else. I am saying that even after a quarter, we'll have to see, because we know very well at 60, 65, our shale gas manufacturers become extremely viable and that production comes on stream, and you know where that cycle goes once again. So let's wait and watch. I'm saying that it won't impact us in this quarter for sure. As far as the quarters going forward, I'm saying let's see. It's not even likely that this will be a problem.
Okay. Thank you.
Thank you. The next question is from the line of Kunal Bhatia from Dalal and Broacha. Please go ahead.
Oh, yes, sir. Thank you so much for the opportunity, and congratulations on a great set of numbers. So just wanted to take a view on, so we've currently achieved 16.1% EBITDA margin. So going forward, what according to you would be of a more sustainable nature, and factors do you believe that you will be able to achieve that through?
So we've given a guidance that we will achieve a 15% EBITDA margin as a ratio of sales. That is something which is good and keeps us right up there with the best in our peer class. We are maintaining that, and we believe that given the quality of our mixes, the fact that our brands are all operating at least equal to the market leader and in some places a slight premium, we are well positioned to maintain that performance. Anything extra that comes out, we like to put it back in A&P, as you know, to grow our brands.
Right.
So we pretty much will maintain it and deliver that.
Okay. Sir, and secondly, I just had a clarification in terms of the numbers which you have given in terms of the GST comparable number. For example, you have given a 372 crores for Q3FY17. So apart from the excise duty, what else have we taken into account?
That's all. Only excise.
So because if I'm...
So there are two kinds of excise duty. One is lying in the other expenses, and there will be something which is in the third party cost also, which will not be visible on the face.
Okay, yeah, that's what I was asking. Okay, so that is the other part.
Right.
Fine, ma'am. Thank you so much.
Thank you. Before we take the next question, we'd like to remind participants once again that you may press star and 1 to join the question queue. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, thanks for the opportunity. Sir, you mentioned that rural continues to do well, and our portfolio also. So just wanted to know if you can share some more light on which part of our portfolio is doing better relatively in rural versus urban.
So I wouldn't say doing better in rural versus urban. What the context in which I said it was that there are certain SKUs like if you take dishwash, and just to contrast it, since you asked me specifically which one is better in rural than urban, if you see my liquids portfolio is more urban centric, even as a market, it barely exists in the rural market, my liquid dishwash, whereas my dishwash bars, again, if you split it, you will find the monthly packs tend to be much more urban centric than rural centric. So from that perspective, yes, there's a difference. Now, your 5 rupee bars and your 10 rupee bars are the ones that are growing the fastest in rural. And how that happens is you're increasing penetration. The rural market for urban bars on a quarterly penetration is less than 20%. So these bars are inducing consumers to move to dishwash bars, otherwise they use proxy products. And when I look at these kind of parts of my portfolio and see their growth, and then look at it more closely, you understand that your rural markets are still firing, that adoption of branded products is still growing, and that is where these comments come from. So that's one example. Similarly, if you look at laundry in those pockets where we have strengths, the 10 rupee pack tends to be the one that performs well in the smaller town rural markets, and that pack has also done well for us. That's another example. So these are really the key parts of our portfolio, which I would say to me indicate that the rural markets are strong. In addition, everything else, of course, goes to rural markets, and there's no major disruption As such, if anything, it's contributed to the growth as it should. These are the things that give me the confidence.
Sure. And sir, when you say that rural uptick is happening, you are referring to retail uptick and not the primary placement, because the disruptions that we would have witnessed in last 4 quarters could also be the reason that you are seeing some uptick in the wholesale channel heavy regions. So is
Yeah, fair
that
enough. So
understandable?
I'll answer that, and how I understand it, let me share with you. If you see the jazz quarter, my general trade sales were 16%. It's actually the second quarter in a row we've got 16%. So whatever upstocking was to happen has happened in that quarter, and that I certainly agree some of it would have been a restocking. What you're seeing in December quarter cannot be possible unless and until you are able to get the offtakes growing in those markets. So that's how you infer that it's not restocking. The restocking story is over last quarter.
Sure. And so lastly, any specific region you would like to call out which is doing relatively better in your revenue mix?
We've shared the numbers. I'm happy to say, as Percy asked me a lot of questions on the coils. Apart from that, everything else is looking strong. Even on Maxo, the liquid vaporizer has grown at 33%. That and Margo are the highest, Margo is 44% and liquid vaporizer is nearly 35%. So these two pieces are a little ahead, but everything else is in the 18 to 20 range anyway.
Sir, I meant region-wise, in the sense states-wise.
Region-wise, okay. Region-wise, again, okay, fair enough. So region-wise, I've had decent all-round growth. The only places where coils are important, which we spoke about, which is specifically the state of UP, I must say even Delhi, wherever this little bit of wholesale disturbance exists, which is Delhi, UP, Bihar, and coils tend to be large. Apart from those, everywhere else we've got good all-round growth. As I said, GT has grown 16%. Nobody has inordinately either pulled it down or pulled it up. Everyone's done well.
Sure. Thanks. That's it from my side.
Thank you. Before we take the next question, we'd like to remind participants once again that you may press star and 1 to join the question queue. Next, we have a follow-up question from the line of Harit Kapoor from IDFC Securities. Please go ahead.
Yeah, hi sir. Just one thing. So apart from coils, where this GST-led wholesale disruption is still continuing, the rest from the balance of the portfolio, how much of it is now stabilized in terms of percentage? So if you can just take the coils part out, because that's still a challenge. The rest of it now would be a steady state growth?
Yeah. The answer is yes. So where we are struggling, the simpler way to remember, since you're trying to isolate which parts maybe you're seeing a trouble, you're just seeing it in certain parts deep down in UP, okay, especially East UP as you move towards Bihar and the state of Bihar, a little bit in West Bengal, where you're still seeing the wholesale channels, especially the ones who are where the coil kind of sales happen. These guys deal with jute, they deal with tobacco, they deal with a bunch of these products. They are still a very cash-driven set of people, and that is where we are seeing a struggle. So it's a smaller portion, and as you can see, even after 30% decline in coils, your business still grows in GT, and coils are totally GT sales at 16-17%. So it's a smaller contribution. Have I answered your question?
Yeah, absolutely. Thank you for that. Just the follow-up was that, after this disruption is largely complete and things stabilize probably another quarter or two, what will be our contribution of the erstwhile wholesale channel versus what it will be now in 12 months time? So pre-GST and probably 12 months post-GST, what's in terms of channel mix?
So frankly, if you're taking it at that holistic level, there's been no major change in ratios. Okay. Let me be very honest. And wholesale is an integral part of this country, and it's not going to go away in a hurry. Otherwise, it would have been pushed away by now. So it will remain pretty much the same. So it's easier to understand saying, look, there are certain parts where there's a struggle. Once they come back on stream, it will cover up that small component of maybe 10% of wholesale where there's an issue nationally.
And if you could just remind me, sir, what would be our overall reach now, direct plus indirect? How much would we be?
We are nudging close. No, direct is what I'll tell you first. Direct, we are upwards of 850,000 outlets. Yeah, after we had completely reorganized from 1 million and corrected it, we've again started growing aggressively. So we are nudging our way to 1 million outlets as far as direct reach goes. Indirect reach will vary by category. Something like an Ujala 30 ml will be in well over 1.5 million outlets. So you'll have to go category by category. But
the largest indirect would be Ujala, right?
Yeah.
Got it. That's it from me. Thanks a lot, sir.
Thank you. Next question is from the line of Dhiral Shah from Asit C. Mehta. Please go ahead.
Yeah, good evening, sir, and congratulations for the good set of numbers. So, what is the revenue contribution from the CSD, segment?
So 12%.
Okay, 12%. And sir, looking at the current volume growth, do you expect this kind of a volume growth is sustainable at least for next few quarters?
You are talking about the 11% volume growth?
Yes.
We will always maintain our volume growth anywhere between 8 to 10%. This quarter is a little on the higher side at 11.5, but I don't see us slipping below that 8 to 10 number.
Okay, so 8 to 10 at least is a sustainable, going ahead. Okay, thank you, sir. That's it from my side.
Thank you very much. That was the last question in queue. I would now like to hand the conference back to Mr. Ullas Kamath for closing comments.
Thank you very much. And if you have any more follow-up questions, you can always contact me. And thank you very much for your participation in the analyst call. Thank you.
Thank you very much.
Thank you, sir.
On behalf of Jyothy Laboratories, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.